This is interestingly the second time venture debt has come up on the show in maybe the space of a month, maybe two. So I'm totally ignorant to it. So explain this to me. So they lend you $6 million.
Yeah.
And you have to pay an interest rate on that. I'm
Yes.
assuming it's more than prime. Like roughly, do you remember what the interest rate was on?
Yeah, I'm pretty sure it was 8%, right around 8%.
At the time, interest rates were probably 3 or 4%. So it's
something like that. Yep.
It's a lot more than you have to pay if you were like a great borrower at a bank.
For sure.
Or whatever. Okay. So the interest rate is 8%. And they also get some warrants or some options to buy the business in the event of a liquidity event. Is that how that's structured?
Well, then on top of the 8%, they actually received shares that were, a small percentage of the business, because the other way we were looking at doing this was just do a straight equity raise. And, the Cerent folks especially said, look, this equity is worth a lot of money. We know it, you know it, but the market might not see it that way today. But we don't want to sell any more shares in the company from their side, and you guys don't from your side. And it was neat, by the way.
What's your revenue at this point, ballpark?
Still. At this point, we had closed, the large deal that I talked about. So we were sort of right at that 10 million in revenue.
Okay. And are you and Cerent starting to develop some opinion on what the whole company might be worth at 10 million in ARR?
Yeah, for sure.
What do you think?
And, at the time, it's tough because it's not just based on revenue, but EBITDA and all these types of things. And we still, at this point, weren't really cash flow positive. The old line that every entrepreneur uses, well, we could be anytime. And, I guess we could have been, but, we would have starved the business if we did that. So we were still not cash flow positive. So you could have paid me at, 10 million times EBITDA and it still would have been zero. So we tried to value it based on the revenue and only the SaaS revenue. So we had little pieces that were services and some other stuff. So we were thinking it was probably anywhere from 7 to 10 times the revenue number.
7 to 10 times your ARR.
Correct.
Or your recurring revenue. And so
yes.
You had 10 million total, but what proportion of that was ballpark?
And, 9-ish. Okay. And what would happen is we would go a little over 10, then we would lose that, large contract in New York for 3.5 million, and then we'd get some other ones. And so it was sort of jumping around that number a little bit. The other sort of worrisome piece was that we had a lot of revenue concentration issues. So we had a few really big customers and then, a decent number of smaller ones. So people would say, well, what happens if you lose that customer? And, they were right. But I guess my answer was, what do you want me to do? Avoid revenue concentration by not winning big customers? It was just, the only way we could see it would be to just keep trying to sell big customers, but they don't come along all that often. Like your number at bats was just not as high as like in, say, a B2C business.
Yeah. So of the 9 in recurring, what would the largest, on a percentage basis, customer have represented?
Our number one was like 5 at the time.
5 million.
Yeah.
Wow. So more than 50% of your ARR from one. Okay.
Yeah.
So that's interesting. But you still thought the business was around maybe 7 times your ARR. So
something around that. Yeah.
Okay. So again, so you're running short of cash, but you got a really valuable asset. And so this venture debt idea of, hey, we'll give you $6 million. That'll help you, meet your short term. We'll get an interest rate of 8%, and we'll take some equity, which ended up
small equity stake. Yeah, I mean, you see, kind of, I kind of felt like there weren't any great options, but it seemed like the best.
Yeah, well, it sounds like a pretty good option because selling equity may have been expensive.
It would have been a mistake, and as it turned out, as usual, the Cerent folks were right. It would have been a mistake, and it was the right thing to do in hindsight, which was neat.
Yeah. So what was the company in North Carolina, this venture debt company, provider of the debt, what was their recourse if you failed to pay the loan back?
Yeah, I mean, that was one of the things we certainly talked about. There was still a business there and there was an asset. So there was an asset, which was our software. And there were a lot of companies that would have been very interested in buying that software because we were being approached by them at this point.
So you pledged the shares in the company to collateralize the loan.
And the asset itself, right? I mean, they were a debt funder. So there was an asset, the actual software. Like, I don't think we ever had to put in escrow or anything, but there was software that literally would be sold to pay off the debt. Okay. And we had meetings with them and talked about some of the strategic companies that were interested in acquiring the company at that point. So there was very little doubt in my mind that if we've just failed to be able to operate as a business, that the asset could have been sold to certainly cover that debt plus some.
And did you and Greg have to personally guarantee the debt?
No.
What about Cerent? Did they have to pledge any of their assets beyond their shares in the company?
I can't remember for sure, but I can't imagine that they would do that because of their shareholders. And I don't think they did either. Yeah, I think it was more a matter of, look, this asset is worth something.